and welcome to the Q1FY22 earnings conference call of RBL Bank Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vishwavir Ahuja, Managing Director and CEO of RBL Bank. Thank you, and over to you, sir.
Yeah, thank you, Margaret. Good evening, ladies and gentlemen, and thank you for joining us for a discussion on RBL Bank's financial results for the first quarter of FY22. I hope you and your families have been safe and well over the last few months. As always, I am joined on this call by other members of our management team, who along with me will address any questions that you all may have. Firstly, I want to extend my appreciation for our employees who have continued to serve our customers all through this pandemic and have kept our operations running smoothly. I am happy to report that we've been able to get approximately 70% of our employees, including those in our subsidiary RBL Finserv, vaccinated, and hope to get everyone fully vaccinated over the next few months. As the pace of vaccination continues, we hope that life and economic activity will normalize to pre-COVID levels soon. The theme for our commentary today is Reset for Transformation 2.0 of RBL Bank. Before we discuss what I mean by that, and before I come to the financial numbers for Q1 FY22, I want to briefly touch upon the impact of the second wave, which has been rather severe and different for a few reasons. While dealing with the first wave, which caused elevated levels of stress, especially in our retail portfolios, we had executed a number of steps to make the bank resilient and stronger. With your permission, I am going to repeat some of them. Granularizing both sides of the balance sheet, tightening risk filters. Taking prudent additional provisioning, leading to improvement in PCR by 800 basis points in FY21, although still short of market benchmarks. Reducing corporate exposures, significantly improving asset quality rating profile of the business in order to reposition it for growth. Rapid ramp up of our retail deposits CASA base. Significant capital raise that took place in that year. Driving other income, particularly core fees. Ensuring consistent increase in pre-provision operating profits, and therefore maintaining the earnings momentum despite the impact of COVID. And then significant reduction in our cost of funds to enhance competitiveness in our lending to facilitate build-out of the new secured loan products. These measures do stand us in good stead entering FY22. However, just as the environment was returning to near normalcy in March, we faced the impact of the second wave, which was far more severe than the first, especially impacting our small retail borrowers, including salaried customers, small businesses, and our rural customers where the impact was the highest. All of which were just coming out of the effects of the first wave with some difficulties. For our bank, these businesses have been our core focus areas. So despite the planned counter-cyclicality in the big business mix that we have, the impact that we faced was higher across the board than some of the other industry players. Furthermore, the resultant impact compared to the first wave was a bit higher because last year we had moratorium, as a result of which accounts did not age. This time there was no such benefit. Impact of the second wave in rural pockets was the worst. Collection efficiencies, for instance, in our micro-banking business were impacted significantly this time, falling to 79% for May and 82% for June. versus 89% through the moratorium last year, before recovering to around 88% in July 2021. Our own impact in terms of staff infections due to COVID, which was low in the first wave, and it has been much higher this time than last year's levels. So as a result of all this, slippages have seen a significant increase in this quarter from what we had anticipated. In terms of the breakup of slippages, as you would have realized by now, bulk of them, 97%, came from retail. Wholesale was the balance 3%. We feel that as economic activity and growth revival is now visible July onwards, plus the vaccination drive is picking up, and with the overall improvement and better preparedness on the health infrastructure front, it augurs better for normalcy to return gradually, as also evident from the high frequency data. Given this background, we have decided that this may be the best time to take a firm view and clear the decks for the future. As such, we are moving forward and have taken substantial additional provisions this time. As mentioned earlier, we have improved our effective PCR by 800 basis points to 52.28% in FY22, and we are committed to improving it further to 60% plus through this year FY22. We have now decided to do all of that in one go in this quarter itself. Our effective PCR is now approximately 61%. Furthermore, we have created additional COVID provisions of 4% on our micro-banking book in particular. This was a one-time decision not only to shore up provisioning and mitigate stakeholder concerns over our PCR levels, but also adequately prepare the institution to come back to normalized levels of business, provisioning, growth and profitability. Given our business traction and competitive strength in certain businesses, starting next quarter, we expect to return to profitability and over the next 9 months make up for the loss of this quarter and should target an ROA of 1% or so for exit Q4 of this year, thus setting us up well for the next fiscal year. That is why we are calling it Reset for Transformation 2.0, and I shall shortly outline the tenets of this Transformation 2.0, which will drive the institution. With this background, now let me talk about our results for the quarter first. In terms of asset quality and related provisioning, our GNPA and net NPA as of June 30th were 4.99% and 2.01%. Our provisioning stance has ensured that our net NPA is down sequentially as well as over this time last year, June 30th last year. Our total gross slippages were 1,342 crores in this quarter, and net slippages were 1,069 crores. Our recoveries and upgrades this quarter were 276 crores, or 21% of our gross slippages. Of our gross slippages, 501 crores was in credit cards, 445 crores in microbanking, and 346 crores in the rest of our retail portfolio, and only 37 crores from the wholesale book. It is our expectation that we should be able to continue to pull back some of these slippages in the coming months, so that the current elevation in slippages is likely to be transitory. Since markets have started opening up in July, as lockdown restrictions have eased, things have started improving on the ground. We have seen collection efficiencies return to pre-COVID levels in July, barring microfinance where it is still approximately 88% and expected to improve further in the next couple of months. So the on-the-ground situation is looking markedly better than a few weeks ago. We took provisions of 1,449 crores in this quarter. As I mentioned earlier, we have increased our provisioning coverage sharply and also taken proactive COVID provisions primarily on the MFI book. Our provisions breakup is as follows. Specific NPA provisions of 808 crores. Additional specific provisions of 365 crores in our unsecured retail and microfinance business to improve PCR, and additional COVID provision of 239 crores. So the additional provisions are 365 plus 239, 604 crores. Partly towards PCR and the rest for as a COVID buffer. PCR is now 60.94% as against 52.28% in Q4 21. Given our accelerated provision policies in retail, especially on the unsecured portfolio, this will naturally improve by another 500 basis points or so by the end of the year. We believe this should be adequate. As in the past, we have also given the gross and net NPAs by each of our business segments in our presentation. Now going into wholesale advances. The composition of the wholesale book continues to be strong with negligible exposure to the vulnerable stress sectors, and it is primed for a good revival. If you look at the rating profile, the loan book rated A- and better is 77.6%, similar to last quarter, and has improved from 67.5% in June 19. Incremental lending over the last 18 months or so has been largely to A- or better, and is reflected therefore in the overall rating mix. On the retail front, our PCR is now, on credit cards, our PCR is now 75.4%, in line with our policy of providing fully and writing off in 180 days. In micro banking, as mentioned earlier, we have taken accelerated provision to increase PCR to 83% on the entire impaired book plus the COVID provision. Lastly, on business loans, our PCR is approximately 45%. In the small unsecured business loans, we have again, like in the MFI book, taken a provision of 75% on the impaired book, as against the normal internal policy of 25% in each quarter. Quick comment on restructuring and the ECLGS schemes. Our total restructuring as at the end of the quarter was 1,152 crores, as against 933 crores as of Q4 21. The current restructuring portfolio constitutes 1.98% of our advances. Of this, wholesale was 435 crores and retail was 715 crores, both slightly above last quarter's numbers. We have taken requisite provisioning on the same. On ECLGS, our total disbursements as of date have been 1,478 crores, as against 1,212 crores as of Q4 21. Of this, 876 crores was in wholesale and 564 crores was in retail. Now let's talk about our operating performance. In the light of challenging environment and our cautious stand, overall advances were flat year-on-year and were down 4% sequentially. Retail advances grew 7% year-on-year and declined 7% sequentially, whereas wholesale advances grew marginally this quarter. Our retail wholesale mix was 57-43. Our performance continues to be steady as reflected through improving NIMs and growth in granular fees and the pre-provision operating profit. Our total revenue growth was 21% year-on-year to 1,664 crores. NII, net interest income, grew 7% sequentially to 970 crores. Other income was up 108% year-on-year to 695 crores. Fee income from our retail business grew 137% year-on-year to 422 crores. Retail fee income to core fees was 75% this quarter. We expect this to trend even higher in the coming quarters. NIMs for the quarter were 4.36%. 19 basis points higher Q on Q. Despite impact of lower disbursements in our retail business, interest reversals, and market pricing pressures in the wholesale segment. The improvement has therefore largely been due to the continuous reduction in cost of deposits. Our pre-provision operating profit was 807 crores for this quarter, a growth of 17% year-on-year. However, as a result of the additional provisions to improve our PCR and the COVID provisions taken, totaling to 604 crores, we reported a loss of 459 crores for the quarter. On the retail deposit franchise, which continues to be very encouraging, our deposit momentum remained very strong. As stated previously, our key objective has been to grow granular retail deposits. Once again, I'm happy to report that total deposits grew 21% year-on-year and 2% sequentially, driven by CASA and retail deposit growth. CASA ratio increased 1.9% sequentially and 3.6% year-on-year to 33.7% at the end of the quarter, driven by, as I said, CASA deposits growth, which was 35% year-on-year and 8% sequentially. The share of retail and small business deposits as a proportion of overall deposits also increased 240 basis points, 2.4% sequentially to 39.6%, up from 37.2% in Q4 21. And this was 7.2% growth year-on-year. Our liquidity levels continue to remain high, with average LCR at 134% for the quarter. Our cost of deposits came out at 5.2% for Q1, a decrease of 107 basis points year-on-year and 25 basis points sequentially. We expect to further cut these rates over the remainder of the year while sustaining retail acquisition momentum. Our capital adequacy ratio as of June 30th, 2021 was 17.2% with a CET1 of 16.1%. In terms of our branch and distribution network, we closed the quarter with 435 bank branches, up 6 branches in the quarter, and 1,422 BC branches, up 57 branches during the quarter. With this, I will now hand over to Harjeet to talk you through some details on the retail businesses for this quarter.
Thank you, sir, and a very good evening to all. I'll outline for you our Q1FY22 experience and how are we seeing things as we move forward from here. Let me start by growth. Growth dropped sharply from third week of April, part self-imposed given the environment and partly due to lockdowns and infections. Therefore, how are we seeing things today? Most urban markets are now open and one is seeing resumption of business activity. Bounce rates are back to normal at Feb-March 21 levels. Resolution rates in the first delinquency bucket, which is 1 to 29 days past due, is back to normal now. Other buckets from 30 DPD to 89 DPD are almost near normal, but sharp falls in resolution rates in May and June in these buckets on account of physical collections is not happening, led to much higher bucket sizes. In July, we have seen the first bucket size, which is the 129 DPD, reduced to below Q4 FY21 levels for business loans and cards. The second and third buckets are still higher and will come down in the next 2 months. Rural semi-urban markets are still lagging behind by 1.5 to 2 months because of restrictions in some of the states like Kerala, West Bengal, and parts of Maharashtra. Also, this time these markets were more hit by infection. Collection efficiency in July in microfinance was much better than previous months, but still low at around 88%. We expect this to improve in the next couple of months. Let's talk about the impact on our portfolio for balance of the year. Gross slippages in quarter 2 of this year are expected to be similar to quarter 1 on account of higher balances in delinquency buckets. Pain is expected to be more in microbanking. We expect slippages to start reducing and returning to normal from Q3 onwards. In microbanking, the customers moving into NPA were paying till April 21, hence recovery chances are much higher. We have already seen that approximately 27% of our customers who slipped in June have paid in July. However, recoveries will happen towards the end of the loan tenure as these customers do not catch up on their missed EMIs, hence don't get upgraded or normalized. On COVID restructuring, under the Resolution Framework 2.0, we centered this more around the secured loan business, and we did about 179 crores of restructuring and a small amount in the microfinance business of about 81 crores and almost nothing in cards. Total COVID restructuring between 1.0 and 2.0 today stands at about 718 crores, which is 2.2% of the book. Little bit about the future business growth strategy as we see today. In credit cards, our new card issuance is ready to be back to March 21 levels. We issued around 82,000 cards in July till the RBI embargo on new card issuance on MasterCard network came into effect from 22nd of July. We expect resumption in issuance when this is lifted or in September 21 when the issuance on Visa network will go live for us. We were in conversation with Visa for many months now, and it so happens that we had closed our commercial terms and started work on IT integrations just before the embargo. Since the technology integrations have started earlier, we are confident of going live in September. We had initially expected a shortfall of about 150 to 200,000 new cards this year versus a plan of around 1.4 million cards on account of this disruption. However, we are confident of covering much of this gap over the balance of the year with earlier than expected launch of cards on the Visa network. Card spends had taken a hit during Q1FY22, but we've seen a very sharp pullback in July 21. We crossed 3,400 crores of spends, which have been the highest ever since the launch of the business. On microbanking, rural and semi-urban markets, as mentioned earlier, are about 1.5 to 2 months behind urban markets in opening up. So you should see microfinance business scale up with a lag of 2 to 3 months. Our focus will be to start doing business in districts where collection efficiencies are comfortable. We also see opportunity in the MFI discussion paper floated by RBI. These would be in the areas of 1, the overall reduction in loan amounts in the industry itself, hence lowering of risk. Second, moving to individual lending in a much more planned manner. And third is additional products cross-sell to members of the households, mainly secured as the household concept becomes more prevalent. The other interesting business which we've been scaling up or which we launched about a year back was home loans. Our focus has been on building this new asset class, and investments in technology branches and people are on track. With the opening of markets and SRO offices, we intend to ramp up our disbursal run rate now. We are setting up a dedicated channel for cross-selling home loans into our own base of customers. We have mapped the existing client base through the bureau and found a very large number of customers that are running home loans with other financiers. There is therefore tremendous opportunity to target these customers through balance transfer. This will not only bring down the cost of acquisition, but will also help us deepen our relationship with these customers beyond the product holding that they already have. Let me talk about a new business which we've just launched, which is tractor finance. Last month, we launched a pilot for tractor finance, leveraging our large presence in rural and semi-urban markets and agri-businesses. The customer proposition is completely digital, with the customer getting instant approvals at the dealer outlet and disbursal happening within a day. In this pilot, we've successfully disbursed close to 600 tractors. We are now in the process of enhancing the technology and also expanding to 250 districts over the next 3 months. Here again, we should start seeing a disbursal run rate of more than 1,000 tractor loans per month by end of Q3 this year. The MSME business loans business. As mentioned in our last few calls, we have completely moved to a much more resilient and safer segment in terms of new business acquisition. In our assessment, the MSME segment has been subject to various challenges, right from demonetization to the introduction of GST and now the pandemic. Hence, a large part of this segment is very vulnerable and will take a long time to come out of this. Therefore, our focus is on businesses which can continue to grow even during these tough times, have their leverage under control, and are demonstrating strong and resilient cash flows. The underwriting criteria has been significantly strengthened. From a portfolio balance perspective, we have exited the unsecured business loan segment. A small part of this, however, will be done as part of our current account acquisition strategy. Now let me talk about our subsidiary, RBL Finserv Limited, RFL as we call it. We intend to leverage RFL in the rural and semi-urban markets, building a comprehensive model for Bharat. RFL today is significantly scaled, with AUM of about 5,000 crores, is present in 21 states and union territories, through 759 branches across 295 districts, and covers over 20,000 villages. It has a staff strength of about 9,000 people and a well-experienced management team and a strong board. The plan is to start positioning RFL as the bank's arm in these markets and its branches as banking outlets offering majority of banking products. We would further enhance the branch unit structure in RFL to include risk assessment and collections, which will be run by the bank. We would be deploying comprehensive analytical scorecards and models to aid the front line for customer selection and decision making. We would share more on this strategy in the coming months. While we will remain completely focused on collections over the next quarter, you will see that there is enough work happening to move into newer growth areas, and we should start seeing results from Q3 onwards. I would now like to hand over back to Mr. Vishwavir Ahuja for his concluding remarks.
Thank you, Harjeet. For going into some depth regarding our retail businesses, I'll now take up the next few minutes sharing with you all our medium-term strategy. In my address of May 4th, 2021, at the time of the last quarterly call, I had mentioned about the reset we were planning to do in our business approach, capital allocation and capabilities. I'd like now to give some more color regarding the same and also enunciate a medium-term growth approach for the bank. The principles of RBL's Transformation 2.0 are built around the following tenets. Emphasizing certain right to win franchises, a phrase we used earlier, where we have a reasonable starting position in terms of scale, market share and capabilities. Incorporating business learnings across market ups and downs, and an ability to deliver above cost of capital return over market cycles. The franchises that meet these tests today are credit cards to start with. In cards, notwithstanding the temporary hiatus because of the MasterCard situation, our plan still is to issue between 1.2 to 1.4 million cards in the current fiscal year. We today account for approximately 10% of new card issuances in the country and with a 5% total market share approximately. We expect to retain this in this range over the next 2 to 3 years. While we have seen higher than normal credit costs in FY21 and perhaps in the first half of this year, this business will continue to generate profitable returns and return to pre-COVID levels in the second half of this year. Our approach over the next 2 to 3 years would be to continue to focus on partnerships with other relevant and well-known brand platforms like Zomato, Bank Bazaar, etc. to be added to expand reach, access to customers. We are undertaking a significant ramp-up of our investment in technology, app design, risk, infosec, and service architecture in credit cards over the next 18 months. That will make us even more competitive, not just against the larger players, but also vis-a-vis the fintechs that are redefining customer experience significantly. We also have to be mindful that cards proposition is being expanded to other segments in India through the buy now, pay later offering. And it is an opportunity for us to leverage our technology and risk management to start seeing the credit card business as a broader consumer offering. Till recently, our card franchise was standalone, but we have now started integrating this with other parts of our banking franchise in terms of cross-sell of savings accounts, insurance, and other retail loans and products. This has required significant technology intervention, which we have largely accomplished. We have around 2.5 million, about 83% of our card customers who use our My Card app. And this is an effective way to expand our services to them efficiently. Conversely, we hope to meaningfully expand our very current low card penetration to our 1 million branch banking deposit customers, which also we expect, the 1 million we also expect to double in 18 months through our traditional and more importantly through our Project Apicus. More on that I'll just elucidate in a little while, which is our digital platform. Now on to micro banking, what we are now calling in terms of transformation 2.0, transforming to Bharat Bank. Ajit has called it Bharat Banking segment, and I do believe significant opportunity exists to build upon a traditionally underserved segment that is digitizing fast. In the very near term, while the present situation on the ground warrants some caution, this is another business where we can expand horizontally into other areas of secured loans, such as two-wheeler, home extension, loans against gold, etc. The draft RBI guidelines on micro banking, we believe, are a long-term positive and will favor better capitalized and scaled-up institutions to expand their business using the microfinance JLG as an entry point into the rural household. RBL Finserv, our 100% subsidiary, is now a significant player in this segment, and our endeavor will be to continue expanding our distribution via them across the country and plan at least 70 to 75% of the districts in tier 4 and 5 geographies over the next 3 to 5 years. The other two business segments that we can't claim to yet have built a large franchise in, but are very important, are the secured retail business franchise, secured retail assets franchise, and our branch banking business. So, talking about the first one briefly, the secured retail assets, the first aspect being home loans. In our housing business, we have 72 branches currently and are on track to add another 50 branches in this fiscal and 120 branches in the next 2 years. This business in the smaller markets will be done via the RBL Finserv branches directly. We plan to build this book with a view to scaling this to approximately 10,000 crores in the next 3 to 4 years. Secured retail assets business loans. Ajit mentioned about a change in our approach and now only focusing on secured business loans. We do this in 2 ways. In smaller markets, it is done directly through our RFL branches now, and we currently have over 150 branches with 1,000 crore plus AUM that have performed much better even during the pandemic. So now we have this experience. We will continue to scale this up via RFL, and the opportunity is indeed very significant. The second channel for our secured business loans has so far largely been DSAs in the metro urban markets. This is a low ROA business, of course. So we are progressively shifting to internal cross-sell and direct sales teams to minimize the costs and engage more with our business customers. We have already activated our branches for cross-sell over the last 12 months again. And we shall expand our branch, as we expand our branch network, this shift in proportions will become more visible to all. Now let's talk about branch banking, i.e. deposits plus. Actually, I should have put this right on top of our Reset 2.0, only because it is absolutely critical. It has delivered significantly during a very tough FY21. And with our digital capabilities, we believe we can move the needle here significantly, notwithstanding our small size of network. Let me first take the expectations from this business over the next few years. Our retail and small business deposits today are approximately 40%. I had mentioned earlier 39.6%, which we want to take to 50% plus within the next 18 months or so. The current cost of deposits has come down very nicely to 5.2% for Q1/22. We should see it at 5% exit before the end of this year. Thereafter, we will keep narrowing the difference between us and the larger banks. We will continue to add 80 to 100 branches each year, primarily in metro urban locations, to add to our branding, customer acquisition and servicing. The branch banking business already does a significant cross-sell of 2.8 paid financial products per customer relationship. This scale and product penetration is expected to increase significantly. In fact, in our deck, we put a slide on this. The big delta of cross-sell that perhaps has been underexploited so far is that of retail assets and cards. This is now a major KRA for the team, and we would hope to be able to share more metrics around this over the next few quarters. And now to Project Abacus, something I had alluded to in my commentary last quarter and a little earlier today. This is a platform that we have been creating in a silent mode for the last 3 years. Our objective in doing so was to figure out how we could increase our customer base in Tier 1 India, chiefly our cards and branch banking segments, without having to disproportionately invest in high upfront fixed costs of branches, people, etc. Our view was that as India takes to a digital financial services, will there be a way for us to create a bigger customer base on our moderate branch and people presence? We have been funding this on a shoestring internally thus far, but now are quite confident and prepared to up the investment and exposure significantly. This platform, and you will see some details of it on slides 53 to 55 in our presentation, already does as much business as our regular 400 plus branches by way of new accounts at a fraction of the overall cost, and the traction we have seen on this during COVID, if sustained, can dramatically change the way we do business with consumers, and the scale and depth we can create can be a positive surprise. All the design, tech and workflows for Abacus have been done in-house. We did not know it then, but this is what the startup world now calls a neobank. Our belief is that incumbents need to leverage their branch and banking understanding to do a complete makeover internally to stay relevant to their customers. In other words, build all that a neobank has plus the deposit licenses that a bank brings. The change will encompass a complete cloud-first technology transformation, customer backwards design, people with different skill sets, and an execution approach that is more akin to a single-threaded team than a typical bank is used to. We have successfully executed against all these requirements of tech skills agility thus far in this 3-year period, but as we said, on a very low scale. It doesn't imply that branches and people are not needed, but that these are tightly integrated into our overall proposition for our customers. As Abacus becomes the main framework of our consumer bank, we will add a credit card customer base to this as well, which right now is a standalone of 3 million customers. If I have to make a forecast, I can say that in the next 3 to 4 years, we shall be able to have a total consumer base of 12 to 14 million customers that would do a variety of products and services with us, spanning deposits, cards, loans, payments, demat, insurance, investments, etc. Just to give you just to re-emphasize the scale of this, currently we have, like I said, 3 million in the card customer base and 1 million in the branch banking, 4 million total. What we are saying is that in the next 3 to 4 years, we could scale up our total customer base to 12 to 14 million, and doing a variety of products, as I just said. These customers will decide the way they engage with us. Branches, app, smart contact center, etc. And because the demographics is with the bank, we should be able to provide them a seamless service, avoid duplication of paperwork, and focus on how they deal with us through their transactions rather than just rely on a typical push. It also changes the way we should account for our business economics, away from product P&Ls to concepts of customer lifetime value. All this may sound a big leap for banks, but for banks of our size and vintage, there is no choice and perhaps no bigger opportunity than doing this. The financial services world of tomorrow will have many non-traditional competitors who will anyways force us to change. So net-net, we are striding on 2 boats right now. The COVID-2 cleanup, where the elevated provisioning has now been largely taken. The second boat is to complete the reset around the principles that I have shared earlier. Notwithstanding the COVID-2 costs, we do see a normalized business momentum to get us to a 1% ROA in exit Q4 FY22 and higher levels thereafter on a sustained basis irrespective. So, to summarize, Q1 FY22 was significantly impacted due to the second wave, hitting lives and health more. We have therefore taken proactive provisions to increase our PCR to approximately 61% and also taken additional COVID provisions. This was a one-time decision to shore up our provisioning and mitigate stakeholder concerns over our PCR levels. We should further increase our PCR to above 65%, as I mentioned earlier, based on our existing provisioning policies. We expect markets to normalize by Q3. Our focus will be to scale up in the businesses where we have built some expertise, namely card, micro-banking, drive growth in housing, maintain retail deposit momentum, while continuing to cut rates in the near term. And we are investing significant time and resources in revamping the bank inside out via Project Abacus. So I think we are set for a transformation 2.0 journey, and we will continue to share more details with you all and benchmarks for you to track us in the coming quarters. Thank you.
Thank you. Should we open the floor for Q&A session, sir?
Yes, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. The first question is from the line of Abhishek Murarka from HSBC. Please go ahead.
Yeah, hi, good evening. So 2 or 3 questions. The first is on the home loan strategy. Now, basically, you said that it will be a cross-sell to existing customers and there would be balance transfers. So, if you can share some details around this, so what kind of customers, leads, self-employed, metro, non-metro, or even from which kind of other financials. So, competing banks would have very low yields. So at what yields are you looking to transfer these balances from? So just some color around what exactly you will do in terms of cross-sell.
Yeah, Abhishek. So this is Ajit here. So first of all, let me just add that is not the only strategy for home loans because we are opening up branches and therefore also doing direct acquisition through our people. But yeah, a substantial part of the home loans should come from our existing customers as well. And if you look at it, Mr. Oja did mention that there are about 4 million customers, 1 million in branch banking and about 3 million in cards. And even if you look at the breakup, card itself is about 70% salaried. So the skew will always be more towards salaried than self-employed. And since these are all within the age groups of, let's say, 30 to 40, 45 years and spread across various cities, you will see ticket sizes ranging between 20 lakhs to about 50 odd lakhs. That is going to be the space in which we will operate. And hence the yields will not be the typical metro yields which we see in the headlines of about 6.7 or 6.8%, but would be more in the region ranging between 7.5 to about 8.5, 9. So that's the space we will work with. When we set out to map our existing customer base of these 4 million customers, we did find a very large proportion of them having these loans with competition, and it will be a mix, banks as well as HFCs.
So when you say competition,
I'm sorry to interrupt you, Mr. Muraka. Your voice is breaking up.
Am I audible clearly?
At the moment, you are.
My question was that when you say competition, what kind of, are these predominantly large HFCs or let's say large NBFCs with a home loan portfolio? What kind of competition are you really looking at?
So if that's why I gave you a ticket size range. So if you look at the ticket size range I was talking about, this will be medium to large HFCs and banks in let's say the tier 2, tier 3 markets. And bulk of this is also, if you recall, I did mention that we will be leveraging our RFL branch network as well, which is there already in the tier 2, tier 3 markets. So therefore, there the competition is more either with PSU banks or with HFCs.
My second question, Ajit, thanks that. My second question is on the slippage guidance. Now, bounce back in check bounces are down. There's a collection effort which is picking up. Bounce rates are back to seven. Am I audible?
Abhishek, your voice is cracking.
Yes, Mr. Muraka, your voice is breaking up. So I would just request you to check your phone line and rejoin the queue. In the meanwhile, we'll take the next question. Thank you. The next question is from the line of Pranav Gupta from Aditya Birla Sun Life Insurance. Please go ahead. Pranav
Hello?
Gupta, your line is unmuted. You may go ahead with the question.
Hello.
Yes, sir, we can hear you.
Yeah, hi. Two questions. One was a continuation of the previous one. So, when we talk about the housing piece that we're looking to build out, is it sort of in conjunction with the affordable housing book that we're already building, or is it sort of going to be a separate business?
This is going to be the affordable housing. So, see, when we say affordable housing, we must keep into account that when you move into smaller markets, your ticket size automatically falls to somewhere between 15 to 30 odd lakhs, and therefore it fits the affordable housing criteria. It is not in the lower end in terms of income strata, but these markets typically have housing costs in that range. And that is why, but yes, it is going to be more and more of affordable housing with a little bit of prime housing thrown in.
Okay, so then in business, we are largely going to be competing with the likes of either the PSU banks as you mentioned, or the affordable housing businesses of the other private banks, someone like Axis Asha or HDFC affordable housing, that sort of segment, rather than the pure play 8 to 12, 15 lakhs affordable housing NBFCs that we have these days.
No, you will therefore compete with the likes of Aavas, Aadhar, Grah as well. But yeah, we've taken a conscious choice of not to target the segment below 10 lakhs.
Okay. And is it fair to assume that the customer mix is fairly going to be more skewed towards salaried versus self-employed going forward?
Correct. That is correct.
Okay. Second question is on the corporate book. So we've seen that book obviously degrow and getting rebalanced more towards the higher rated corporates. But if I look at your presentation, I see that corporate yields have come down to as low as 6.7%. Now at your cost of funds, which is 120 basis points higher than the larger banks. How do we see this business going forward? Because at a spread of 1.2%, this business seems to be really tough. So how should we look at this, and what is the strategy going forward over here?
Yeah, Pranav, very clear. So I think the current yields are also a little bit colored by some excess liquidity that is being deployed at the short term on wholesale banking. I think as we see demand coming back, right now we are also in a very subdued demand environment. Our focus will be to really grow in the commercial banking and the lower end of corporate banking space, including leveraging our GIFT City business. We also have the current yields are also, by the way, influenced by almost 8 to 10% of foreign currency yields. So if I take rupee yields, you could add approximately 60-70 basis points to that from from a like-to-like comparison perspective. So the idea would be to not really, look at AAA names, but, really go down to the A plus, A minus names in the 30 to 100 crore ticket categories. And this will take time. It's not going to be a, dramatic growth situation that we are sensing right now. It will take time. And please also understand that we will continue to reduce our cost of deposit, cost of funds. So we should easily target a sub 5 cost of deposits by in the next 6 months or so through a combination of cutting rates and improving CASA. So I guess it's a combination of all of this that will happen. Having said that, I don't think we will be as profitable as a 4% cost of funds bank. That's a reality we will deal with.
So is it then fair to assume that over the medium term, the mix will continue to shift towards retail, given that corporate is going to be a late or is going to grow more in the medium term rather than the near term?
No, actually it's the other way around. Near term, we might, just because retail will probably be subdued for another maybe 3 months or so. So the growth drivers for retail will be obviously market coming back for our core products, as well as some of the pilots and the initiatives that have been going on for the last year or so between home loans. Sorry? Yeah, I was saying that the retail growth will also be driven by the newer products. So yes, you're right that in the, let's say, 2-3 year time frame, I guess clearly retail growth should be higher than corporate.
Okay. And could you give us the cumulative write-off on the credit card business throughout the pandemic, probably over the last 9 or 12 months?
It should be in the range of, let's say, if I take the last 3 quarters, because there would not have been much before that, should be in the 1100 to 1200 crore range.
Okay, and just one last clarification, sort of an obvious one, but still clarifying it. This GNPA and NNPA slide segment-wise that you've given is a breakdown of the 4.99% number, right? Rather than obviously the individual businesses.
Correct.
Okay, so in that case, just one last follow-up. This 1 or 90 basis points number on the credit card business, sort of implying an overall stress level of 14 to 15% on the book. Is that fair to assume? If I include the write-offs and the restructuring and all of that.
Yeah, see, if you look at credit costs for credit cards, I think we had about 10.5% give or take last year. And in the first quarter annualized, we would be, similar range, I guess, give or take, in terms of annualized credit costs.
Sure. Thanks. That will be all from mine.
So what was pre-COVID running in the 5 to 5 quarter range is generally been running at about 10 quarter in COVID 1, and unfortunately in COVID 2 in Q1 also it's been elevated because of COVID 2. So yes, so that's the range it has been running. We should expect this to come back to the 5.5% levels as we exit the year or second half of the year.
Right, but I mean, if I just look at your customer mix, the details that you've provided for the credit card business, a large chunk being from salaried, almost 70% plus, and even if I look at the mix of, within the tier 1, tier 2, tier 3 cities, almost 70% being in tier 1. credit cost seems slightly higher. How should we look at this? You mentioned that you've tightened the standards of underwriting going forward, but isn't it? It's slightly surprising looking at the details that you provided in the customer profile that at least this sort of credit cost.
Yeah, I think you need to look at 2-3 things when you look at the credit cost for the cards business. If you look at the second pandemic, the entry rates into delinquency did not go up. They went up by just 1 or 2% over what was there, let's say, in Jan, Feb, March of this year. But what had happened was that your field collections actually, their efficiency went down dramatically in the months of April, May, June. And that is what has caused the buckets to bloat and slip. So your credit cost is going to be a function of what is your entry into a delinquency, which, by the way, in the first wave was fairly elevated. But in the second wave, it was not elevated at all. And if you want to get a little flavor on this, if you look at the slide 47, where I've given you collection efficiency by buckets, you will notice that the first bucket, which is the 1 to 10 DPD, which is largely through telecalling, we did see a dip, but we quickly recovered there because the telecalling was still possible. But all the balance buckets are where the physical collection happens. And once that gets impacted, there will be a large flow through which will happen. So there is, this is something one will have to live with, that this flow through will happen. It will move into NPA. And then charged off and recovery will happen from it. So you will see a very large recovery coming in some part of this year, but a large part next year as well. Because these are customers which were perfectly fine. They were not stressed, but every time you have a delinquent customer, you need to go and collect. And if that collection machinery gets impaired, the flow through is that much higher.
Sure. I have more questions. I'll probably connect offline and get better clarity on.
Sure, Pranav.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal Securities. Please go ahead.
Hi, good evening, everyone. So, a few questions. Firstly, we have now significantly upfronted the provisioning this quarter and covered a long distance on PCR. And yet we are guiding for nearly 1% exit ROA for the year. So while 1% of course looks good from where we are right now, but we just wanted to understand what sort of credit costs are we looking at for the year? And is this like a sort of a conservative number that you're putting out?
No, so Nitin, sorry.
No, go ahead.
Nitin, I think, I guess it's a function of many things. I think we are, you could argue we are conservative. I think it's also that as we look at what has happened from a provisioning standpoint is that we have taken the extra PCR and the COVID provisioning to largely say that we should come back to some sort of a run rate provisioning by second half. And the run rate itself will be higher because of the mix of businesses we are in. And one of the things is that we need to have a substantially higher growth come back. So I think the balance sheet has been roughly similar sized for the last, COVID impacted period. And therefore the jaws of operating income being higher than cost, etc., will happen when the growth begins to materialize in the balance sheet, which we think should happen by early next year and not so much by the end of this fiscal.
Okay. And the other question that I have is on the card business. Now, after the spends revival in July, how much further room do you think there is like overall in expense normalization? And particularly the mix of customers also, while the share of transactors is going up, but that still remains comparatively lower versus others. So how is this mix likely to evolve?
Yeah, so I think spend metrics July are at all levels, while in the presentation we've given you till June, but at July levels we are perhaps seeing the highest spend matrices across. And therefore I don't expect spend on existing customers to go further beyond this, but you will see more of new customer additions and therefore spends coming from there, which will go up, which is there. And you had a second question? Sorry, I missed that.
On a mix of customers, how is that likely to change?
Yeah, transactors. So if you see transactors, actually volumes are fairly okay. when you look at a percentage, you are seeing it as lower only because the term population is term balances are higher. Please note that almost about 75 to 78% of the term balances are also transactors. Just that they've converted their transactions into loans. So the transactors are higher. In fact, across all at industry level, I think most of us will start seeing revolvers come back, because what has happened in this period is that most of the revolvers have flowed into delinquencies or NPAs, and therefore the revolve balances have actually started coming down. And that I think will start coming up and bring up the income dynamics for the business. But I think from a pure transactor or customer spends point of view, the business is pretty well placed. It's now the new customer acquisition will further take up the spends.
Okay, and as you're saying now the new customer acquisition will drive the overall spending in the card because the normalization is almost sort of done. But the mix of tier 3 cities is going in the total acquisition chart if you look at. So how is this going to affect the per card spend, and how has been the delinquency trend in tier 3 cities?
Yeah, so a couple of things on tier 3 cities. I think we've seen that if the customer starts spending, engaged customers who spend or active customers, the spend levels are fairly similar to your larger markets. They're not. The only thing one has to work on in that the active rates. The active rates in tier 3 cities are lower. And therefore that is what one has to work on to see how do you get those customers engaged at the same level as what the large market customers are. And that predominantly also happens because large market customers are used to using their cards because they're multi-carded. And hence that same effort has to be made on the smaller market customers. From a delinquency perspective, tier 3 markets are better than the larger markets, purely because the leverage is much lower.
Okay. And lastly, if you could share the data points on interest reversals during the quarter and what was the impact on margins due to that?
Just 1 second. We would have had approximately about 80 to 100 crores of interest reversals in Q1.
Okay. So basically 40-50 basis points of margins got.
Yeah, that's right. But if you compare to pre-COVID also, there will always be some interest reversal, so the delta would be lower. But yes, otherwise what you're saying is right.
Okay, sure. Thanks so much. I wish you all the best.
Thank you.
Thank you. The next question is from the line of Sameer Bhise from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Question on operating cost. There is a slide which indicates that there's a spike due to infrastructure cost. Also, secondly, wanted to get a sense on how OPEX would move and what are your thoughts given the branch expansion that's planned.
Yeah, so I think broadly we've been adding branches quite aggressively, including during the, as soon as we came out of the COVID period, we've been adding branches. I think the idea is to continue to do that, maybe even accelerate. Because I think one of the key focus areas, as Mr. Ahuja also mentioned in his speech, is to granularize deposits, which is one of the core focus areas. We are also adding to technology investments, as again alluded to in the speech in terms of what we have been doing. We've even partnered Accenture in the recent past to revamp the way we do technology investments. So those were some of the reasons, and also, ultimately when retail growth comes back, which is, cards coming back, etc., these are generally upfronted costs, origination costs. So with business volumes going up, going forward, we will expect costs to go up during the course of the year. So we will have a somewhere in the 30% range increase in cost year on year, I would say, if I have to give an estimate.
Okay, so that kind of growth rate will sustain, you think?
Yeah.
This is helpful. Thank you and all the best.
Thanks.
Thank you. The next question is from the line of Manish Shukla from Citigroup. Please go ahead.
Yeah, good evening. Harjit, first question on cards. When you mentioned physical collection on cards, I'm just curious. 70% of the card base is salaried. So why does it need to be a physical collection effort?
Manish, I would have loved it if everything would have come on the phone. Unfortunately, it doesn't. We've noticed that once the customer slips beyond 10 DPD, you would need to knock on the door to be able to get this, because it's not just cards which the customer is under stress for, and you would want to be the first person there to recover your dues before the other loans. And that's the normal philosophy one would follow on any unsecured loan for that matter. And that is the reason why physical collection becomes important. Because after some time, it's very easy for a customer to just stop taking calls. And hence you need that knock on the door.
And this is not just a post-COVID behavior. This is BAU, the 10-day number.
The collection strategy physical is a very, very BAU number. In fact, for most of the unsecured products, it is quite a lot physical, which augments it. You use telecalling initially because that's where bulk of your early, let's say, lazy pairs are removed from the delinquency.
Okay. And when you say tier 1, tier 2, tier 3, are these RBI definitions by population or is it defined separately?
No, it's defined. So the tier 1 is typically the top 10 cities, and then tier 2 is the next 25, 30, and then tier 3 is the balance.
Okay, fine. That is clear. The other question, maybe Jaydeep, you can answer. QOQ, the yield on loans are up almost 40 basis points. What explains that?
I think we were
because slippages are similar. Retail has declined more than wholesale. So I'm just curious, why should yields go up so much?
Yeah, one is I think the interest reversal would be less this quarter than last quarter. The second would be that if you look at we would have shed some corporate lower yielding loans which we were carrying in March because of excess liquidity. And if you look at our LCR, technically we are down from, let's say, 150. So the excess liquidity is marginally come down. That would have been the other reason.
Yeah, so that was my second question, the 20 percentage point fall on LCR QOQ. I mean, where has that got deployed, or how should one look at it? Because the balance sheet growth in aggregate doesn't show up in the aggregate numbers, hence I'm wondering.
Yeah, I think there are some more nuances, Manish, and we can probably have a more detailed call offline. But see, for example, we will have lower non-pre-mat deposits. If you have non-pre-mat deposits, you will typically have zero outflow. So those are also generally bulky in nature. So we've kind of gone down on our top 20, top 100 quite materially because the growth is coming from retail. So and there is some reduction in excess liquidity consciously.
Okay, right. Really, the last question, we talked about exit ROA at ballpark about 1%. Any thoughts around exit NIMs?
Oh, yeah.
Yeah.
I think similar to what it is.
Okay.
It should get slightly better.
Yeah. I mean, there is scope on the upside, but next quarter will remain muted in NIMs. But after that, we are hoping that we can improve them.
Sure. Those are my questions. Thank you.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. Hi. So firstly, in terms of broadly under this transformation 2.0, and finally, when we look at the various initiatives that we have been taking all across, so finally, how should we look at the book mix over next 2 to 3 years? Does it change in any way given the circumstances, or what has been the learning? Or broadly, so you alluded that it will be largely business loans card, but how would be the proportion panning out over a period?
Kunal, Rajiv here. I think we should look at a 35% wholesale and about a 65% retail. And the secured business should keep improving, as should cards. Microfinance, as we said, we'll watch for a couple of quarters before we bring the growth back. But even in microfinance segments or the households, in addition to microfinance, there will be other horizontal services and products which we will endeavor to put. So take it as like 35-65 in a 3-year time period.
Yeah, and structurally margins should also be down. Maybe this year we are still riding for an improvement out there. Okay, but structurally should we expect it to be down given the proportion of the secured and all is gonna go up? So yields would definitely have picked out. Would that be the fair assumption?
No, Kunal. Actually, you have to see that we are carrying a wholesale book which has about, I would say, 20-25% of the book is actually very, very low yielding. So we will be able to redeploy that once demand comes back and we are prepared to ramp up on our growth. I don't think we are looking at the average, spread on our business being materially different. There will be some cost of funds advantage. There will be some of our business loans as well as our MSME loans which will improve. So will the card growth happen. So I don't think this is being guided to that. I mean, if you remember, we were 50% or plus thereabouts in wholesale about 5-6 quarters ago. It's 43 arithmetically right now because retail hasn't grown or has degrown. But over the next 3 years, retail should be about 65%. So all of those yields are far, far better than the wholesale yields which we have currently. We obviously expect the wholesale business, especially in commercial banking, to come back. We don't know, but my guess is in the next 6-9 months we should see somewhat of a better than what we've seen, but still the average yields in retail will be higher than the wholesale book.
Okay, sure. And in terms of write-offs, so if you look at on the credit card side, so almost like whatever was outstanding GNPL, mostly everything has been written off, and maybe the overall slippages which you have highlighted for this quarter, that is what is now outstanding. So would that be, so maybe how would have been on the existing GNPL book of in credit card of 500 odd crores, should we say that it is just like accrued in this particular quarter and can be recovered, or there is some stickiness out there of the earlier quarters as well?
So there will be a little bit of stickiness, but yeah, broadly when an account crosses 90, it kind of flows into 180 and then the recovery starts happening post that. Roughly over a year and a half, one recovers about 30 to 35% of that.
Yeah, no, so the way last time the credit card, I think GNPLs were around about 680 odd crores. And I think that entire, maybe that proportion, similar kind of a write-off has been there in this quarter as well. Okay, because I see credit card GNPS coming down to 500 crores. And this is what you highlighted as a slippage number, is maybe out of,
Yeah, Kunal, I think you said this in the past. Credit cards automatically get written off at 180 days. In fact, therefore, the GNPA on credit cards is never a reflection of the business. It's the credit cost which the P&L takes. Sure. So the GNPA will always be low because it will not carry burden beyond 180 days.
Yeah, no, I am saying it was largely like 90 odd days as well. So that's why maybe 100% of GNPL is being written off. Yeah.
Okay.
Yeah. Oh, okay. Got it.
The recovery is only about 10%, which comes in post 90, between 90 and 180.
Okay, it's hardly 10% kind of a recovery.
Yeah. Because the main recovery comes after that is when you get your recoveries going.
Sure, got it. Okay, yeah, thanks a lot.
Thank you. The next question is from the line of Mahrukh Adajania from Elara Capital. Please go ahead.
Yeah, hi. My question was that do you find any material difference in delinquencies from the book originated by BAF and originated by you?
You're saying between the book originated by Bajaj Finance and the rest of the book?
Yes.
Yeah, not much. It's about 20 to 30 basis points. That's it.
Okay. So theirs is better or worse?
Better. Theirs is better because it's a tested customer.
Got it. Okay. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Rohan Mandora from Equirus. Please go ahead.
Yeah, thanks for the
Sorry to interrupt you, Rohan. Your voice is not very clear. May I request you to come on the handset mode?
Yeah, is it better?
Yes, this is Better. Thank you.
So, sir, on the cards portfolio where you are showing the 1 to 10 DPD and the resolution rates there. Now, if you look at the resolution rates in that segment, it's almost 97% and 100% for the 3 months. And still the flow through is pretty high. So would it be fair to assume that these are just the month-end numbers and during the month if there is some slippages, that those would have flown through into the higher buckets?
No, the card collection, card resolutions, card runs by what we call as cycles. So it's not month-end numbers. You have to keep in mind that the 1 to 10 DPD resolutions, when you say 100%, is not 100% resolution, it's 100% as in it's indexed to pre-COVID. Typically, these numbers run in the region of about 96.5 to about 97.5%. The real slippage which you are seeing is because when you see the next buckets where the resolution fell, which is what I was referring to earlier, where the field collections fell. Those numbers, if you see, dramatically reduced.
Sure. And the second was on the current account circular. Is the impact of that completely over on our books, or is there some further outflow that can happen on the current account? Because we may not be having a 10% market share in some of those accounts that we may have current account relationships.
Yeah, this is Surendra here. So on the current account circular impact, there is obviously a little bit of gain and a little bit of loss which is expected. We are working on both sides of it right now. Most of the impact has been assessed. It may not materially impact us over this period. There is some more impact left which is going to happen in the month of August, but it will not be material to make an impact on the overall business.
Sure. Actually, lastly, in terms of the exit quarter ROA of 1%. Sorry?
Yeah, go ahead.
Yeah. So, sir, in terms of the exit quarter ROA of 1%, is it contingent on the business as usual credit cost that we are factoring in for 4Q? Or will it still have a slightly elevated credit cost in 4Q?
No, but by Q4 we should come back to reasonably close to BAU credit cost.
Sure, sir. Thanks a lot.
Thank you. The next question is from the line of Sachin Upadhyay from Play Securities. Please go ahead.
Hi. Thanks for taking the question. Just wanted to know 2 things. In terms of, you just highlighted that 25% of the customers is effectively low yielding. Could I actually know the book duration or tenure? And second is, in retail, what will be the product per client which is there right now? And if you could give me a similar number last year, same time. Thank you.
What is the question? I didn't understand the first question.
The duration of the wholesale book portfolio,
which is low,
is quite short.
Quite short, yeah.
So that will be less than 3 months?
Yeah, in the 3 months, 6 months range. Yeah.
Okay, fair enough.
On the product holding, Sachin, can you repeat the question?
So I am looking at product per client in the retail segment. If you could kind of share that data, as in what will be the current product liability asset both mix per client and retail?
We have a product holding in the retail world at 2.82 right now. And it is improving in the range of about 15 to 20 basis points on an increased base of customers every year.
Okay, thank you.
Thank you. The next question is from the line of Jai Mundra from BNK Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. I have few questions. First, on your slippages, so you had mentioned that even the 2Q may have similar kind of slippages. So just wanted to check, is there any element of regulatory prescription as to why the slippages are slightly higher at maybe 10% annualized? I mean, like there was an RBI circular on daily tagging of NPA or anything else which may have led to higher slippages apart from the COVID, of course.
No, Jay, there is nothing with respect to RBI guidelines. We moved to daily NPA almost a year plus back. So this is purely on account of COVID. I think just to kind of give you some context, COVID one, people were just coming out. It was not as if everything was perfectly fine. It was just coming back to some sense of normality when COVID 2 happened with all its complexity. So and the business mix that we have got a little more impacted because of the business mix. So there's nothing regulatory in this at all.
Right. I mean, nothing specific to say RBL Bank, for example, right?
No, absolutely not.
Sure. And a second thing on credit card ban, right? So, well in time, you already have entered into partnership with another network operator. And I think, MD sir also mentioned that there would be around 2 months delay from now, within which you would start sending out new cards. But in a card business, do you suspect that there could be a lead lag, or there could be lag also? For the next 2 months, you are not issuing any card, and there may be some lag impact of cards issued before they start earning revenue meaningfully, and hence your top line also in maybe not only in 2Q but 3Q also maybe may get impacted with the lag.
Yeah, you're right. Card revenues do come with a lag because customer activation happens over 90 days. And therefore there is a lag which will come in terms of the spend which one is expected to have from these customers, which would have been acquired in the month of August. But I think luckily we've been able to shrink that timeline, and that is why we said that we should be able to launch that the new partnership in September. Now, if you look at even July, we were despite the ban, we were still able to issue about 82,000 cards. The reality is, whenever we launch Visa, we will launch and start sourcing a little earlier. So the objective is to try and minimize this. So by the time we end this year, we won't have too much of a gap, which will therefore impact the overall performance of the business. In any case, in the short term, a new card is always a drag on the P&L. So if you're coming from a P&L perspective, then it's not that much of an issue.
Understood. Right. And just on restructuring, so you had given some 715 crores retail restructuring. If you can further divide that into MFI, credit card, and others.
Yeah. So in this 718 crores, about 458 crores was restructuring 1, and about 260 crores is restructuring 2. And within this, microfinance is about 111 crores. Cards is about 179 crores. All card restructuring is restructuring 1. There is no card restructuring in R 2.0. And the balance is all retail, which is business loans, etc.
Right. So, this is the outstanding number, right? 1 crore and 1 cent.
That is right.
Sure. And just one more thing. Now, assuming a similar slippages in 2Q, and you maintain PCR or probably take it ahead, right? So even then, the provisioning requirement, you may have to dip into the contingent provisioning that you have already made in this quarter, right? Or unless you have something else in mind. So is that understanding correct, that if the slippages are similar and you increase the PCR from here on also, you may have to dip into the contingent provision that you have created in this quarter?
Yeah, that's a call we will have to take at the end of the quarter. But, the belief is that if COVID-2 is settling down well, as we are already seeing in July, then we will obviously reevaluate the need of how much to carry forward and whether we should claw back something. Yes.
Right. Okay. Yeah. So sorry, sir. I missed that slippages break up from in the MFI and credit card. Yes, sir. Thank you. If you can repeat that, the slippages break up.
Approximately 450 on MFI and about
500 crores in cards.
Sure. Thank you, sir, and all the best.
Thank you.
Get that number.
Thank you. The next question is from the line of Zishan from Point72. Please go ahead.
Hey, evening. Am I audible?
Yes, you are.
Yeah, thanks for taking my question. So first on growth, just to clarify, so is it safe for us to think about this year, FY22, as more of a transient year around growth because of COVID? So maybe we are likely to see like flattish loan growth similar to last year, and then FY23 we will start our kind of growth phase.
Yeah, I think you're right. FY22 will be a year of consolidation. We could see growth in the second half. Like we said, our other businesses could grow, wholesale banking could grow, retail assets could come back, housing will certainly grow. Microfinance will be a little circumspect until we see a clear line of recovery in the rural markets, which are lagging urban markets. So yeah, I think we could grow overall as a small percentage, but I don't think I can call that, something which is dramatically changed. We'd rather use this period to get some of the other stuff we are doing much stronger. And FY23 could be a more normalized year of growth, obviously on the back of a lot more clarity on where things are and what we would be doing in terms of our risk exposure and management.
Got it. That's clear. Thanks. And the second is on the credit cost. So your guidance was second half likely more like 4Q, likely a BAU kind of credit cost. Should we assume like somewhere around 200 to 50 bips of credit cost as a normalized credit cost, or?
Annualized? Fourth quarter.
Yes, that is right.
Right. So BAU credit cost annualized is about 250.
Yeah, I mean, it will also make a difference basis the product mix, but broadly, if I want to kind of give some split here, we should expect cards to normalize to somewhere in the 5.5 range plus minus, which was what we were doing pre-COVID. Microfinance could run at about 2.5%. Secured retail will run at about 1.25%. So I think it will depend on the mix. But yeah, broadly we should be in that range. But we will want to see when we get there before giving stronger guidance.
Got it. Understand. So on restructuring, are we seeing more inflows in the current quarter? And is there any color on where the total restructuring is going to end up?
If you look at least on the retail side, when I gave you the numbers, you will notice that the numbers in the second restructuring are fairly much lower than what we saw in the first restructuring phase. We are seeing a little bit of restructuring happen in the business loans in the MSME segment, and a very small amount happening in the microfinance segment. Cards, there is nothing which is happening.
And wholesale, of course, there is no more restructuring.
Got it. Understand. And on PCR, so we are at, I think 60%, if not wrong, 61% this quarter. And I think previously we talked about 65% kind of target. So given that it's kind of COVID year, so how should we think about the timeline to achieve that target?
So we mentioned in my commentary that during the year, before we end the year, we will be above 65. We said that through the year, through our provisioning policies as they exist, we should easily add 400 to 500 basis points more during this year. And so hopefully that should happen by itself.
Got it. Understand. Okay.
I mean,
and just lastly, so
we also have that COVID buffer on top of that.
Right. So if I put all this together, is this safe for us to think about credit costs this year to be higher than last year because we're bringing our PCR up?
Yes, credit costs, because you've taken, effectively year on year, PCR would have gone up 13-14%, FY22 over 21. So that does require provisioning, and therefore it goes into credit costs.
Got it. That's clear. Thank you so much.
Thank you. The next question is from the line of Rashi Talwar from Ashmore, India. Please go ahead.
Hi, good evening. Just a quick question from me. The cost to income ratio saw a reasonable pick up this quarter. I was just wondering why and what should we, is there any one-time stuff in it which will normalize going forward, or should we, budget in a higher number going forward?
I think Jaideep can provide you more granularity, but all I will say is that last year's number was very suppressed because, there was no growth-related costs, which largely come from credit card and other businesses. So, as you know, that is a very upfronted cost model, and last year, since there was no issue literally happening, those costs were not there. Also, our costs in our investments in branching technology continues, and we are talking about some more ramp up in those investments. So, some variable costs associated with largely cards, are going to come back this year, and we need to put in the normal, if I may say, investment-related costs that are also there. So yes, if I may say, you should budget 2-3% higher costs, in terms of the cost-income ratio this year.
Okay.
Yeah.
Thank you. Any other questions?
No, I'm done with my questions.
No, I'm asking Jaideep. Do you want to clarify what I said, or are you okay with that?
No, that's fine. And I think, just a point to add that as we are in the current environment, we are also not substantially growing the balance sheet. It will be a single-digit kind of a growth situation. So, somewhere I think on the same cost base, we could be much bigger, and which will begin to kind of reflect itself starting next year. So to that extent, that's also the other reason, because we could support a much higher balance sheet at the same cost. So that will happen over a period of time. And that is how the cost to income should also trend down after the the subdued growth situation starts transforming itself.
Okay, thanks.
Thank you. The next question is from the line of Dhaval Gada from DSP. Please go ahead.
Hi. Two questions. First is related to the credit cost guidance. I think Jaideep highlighted that it should normalize the fourth quarter. I thought earlier our expectation was that we'll have a write-off in the first quarter, and thereafter we'll start normalization to 5.5%. So is it higher than expected stress from wave 2, and that's the reason it's getting pushed out? So that's question number one. And the second question is related to upgrades during the quarter. Does that include any restructuring implementation related upgrades? Those are two questions. Thanks.
Yeah, so on the card side, we had said that earlier last year we had said that the credit costs will slip into the first quarter. The second wave has made it slip, added another quarter to it. So it's not the fourth quarter, but credit cards will normalize in the third quarter itself for cards.
Second question?
Thanks. And the second one was upgrades during the quarter. Does that include any restructuring implementation related upgrades? Accounts which would have slipped and upgraded because...
Not material.
Okay, perfect. Thank you. All the best.
Are we there?
Any other questions? Any other question, Mr. Tara? All right, thank you. The next question is from the line of Rakesh Kumar from Systematix Group. Please go ahead.
Yeah, hi, good evening. Can you hear me, sir?
Yes, please. Go ahead.
Yeah. So the first question is with respect to collection efficiency in microcredit. So it is low still, and how do we see it going ahead?
So if you look at it, we've seen a little bit improvement in July. It was hovering around 81, 82% the previous month. It's jumped to about 88. And that is because somewhere in July you did see some of the southern markets open up. We still have some markets around West Bengal and Kerala is still under some restrictive opening timings. It will climb up, but as I said, I think it's about 2 months behind urban markets. So you'll see these inch up over the next 1 or 2 months till it reaches comfortable levels of about 95% plus.
Got it. Second question is with respect to that a majority of high yielding credit books either has slipped or has got restructured. But I am very surprised that your credit yield has actually moved up. And LCR thing is very very deceptive because it depends that how the high quality liquid asset composition is. So if you provide what is the excess SLR and excess cash you are holding on a quarterly basis, that would help more because it does not explain complete impact on margin. And I think that margin is kind of at the top level. Is it going to fall from here and how much? So if you can help me on this second question. Thanks, sir.
Go ahead.
Yeah. So I think margins will have multiple factors. The proportion of different businesses. We have yields as high as 20% on a blended average basis with cards, vis-a-vis as low as the lowest corporate book advances could be as low as 4.5%. So I think it's a wide variety, and it will depend on how the mix shapes up. Plus, it gets influenced by reversals of income basis slippages in each of these categories. Having said that, I think from an expectation standpoint, I think as we go towards the end of the year, as slippages normalize, especially in the higher yielding books of microfinance and cards, clearly that will be one tailwind for margins, along with, of course, reduction in cost of deposits. In the very near term, we could be flattish to marginally down, maybe 10 basis points down. It's very difficult to predict given too many factors here. But in the near term, I would say it is probably a little down rather than up, but exit should be trending up. That's how I would look at it.
And last question, sir, on this credit card, cumulative gross NPA, including return of loans, and then the provision coverage for credit card segment.
Is that information there on one of the pages?
Cumulative written off, GNPA plus cumulative written off.
On cards? Cumulative written off from when?
Yes, from the last 1 year.
Yeah, so last year we wrote up about 10 to 10.5%, and you have about 4% as the GNPA. Is that what you're asking?
Yes, that was the question. Thank you. Thank you, sir.
Yeah, thank you.
Yeah.
Thank you. The next question is from the line of Anand Dama from MK Global. Please go ahead. Anand, your line is in the talk mode. Please go ahead with your question.
Sure. Yeah, thanks. So basically about the restructuring. So we have seen many banks, NBFCs actually have done heavy restructuring instead of recognizing them as NPAs. What basically made us not restructure much and take the pain upfront? Is it basically the underlying customer itself was weak and where we took a call that he is slipping into 90 DPD bucket and basically you will not be able to recover those dues, and that's the reason you chose not to restructure but to take the pain upfront, primarily for cards portfolio, microfinance and the business loans portfolio. So what was the thought process for that?
Yeah, so I think fundamentally when we did restructuring for cards under the first restructuring policy, most of it was done in the months of September, October and partly November. We did see that it doesn't really help too many customers in terms of them being able to come back into the normal way of functioning on the card. And hence this time we took a conscious call of not pursuing restructuring to that effect. And that is why we've almost done nothing. There's only 13 lakhs of restructuring balances which have been done in the last quarter. Microfinance, same. Unsecured loans, see, for that customer segment to understand what a restructuring means doesn't work. That customer only understands that she has to pay her EMIs which are equal to the tenor of the loan and she continues to pay that. It's not that she will be in a position to pay them upfront or anything. So rather than restructure, you let it go and the customer keeps paying and therefore the loan gets recovered over a period of time. So that's been the philosophy on the unsecured side. Wherever we've tried to do restructuring is more on the MSME side because there we genuinely believe that the businesses who got disrupted because of lockdowns and restrictions, and these are perfectly fine running businesses, and if you give them time, they will be able to come up. So these are largely secured businesses. And hence, even from a hierarchy of payment, we expect customers to really pay more on these businesses, and hence restructuring has been focused more on the MSME side. So that's been the going in assumption, and that's why you're right. For most of the unsecured segment, you will find our restructuring numbers much lower than the rest of the industry.
Yeah. And that's also the reason basically that in the second quarter you are expecting the slippages to remain elevated, that whatever flow that you have into 1 to 90 DPD pool is basically you would try and upfront it rather than defer it.
That is absolutely right. Absolutely right.
Yeah, that's good. So secondly, the question about...
One time, yeah. No, correct. That is the philosophy, to clean.
Okay. And secondly, basically you are also trying to ramp up the provision cover as such. Sir, any color that you have given in terms of SMA 1 and 2 pool? I know that basically you have given the buckets as well. But if you can just tell us basically what will be the SMA 1 and the SMA 2 pool on a cumulative, on all the portfolios altogether.
I don't think we're carrying that for all portfolios, but these remain elevated in as we mentioned in microfinance and cards. So maybe I'll just give you the data point offline. I'm not carrying the SMA data right now in terms of rupees crore.
Okay, and is it basically into higher bucket like SMA 2, so that whatever slippages have to happen would largely happen in second quarter and then we will have a normalized slippage? Is that correct?
That is correct. It will be a mix of SMA 1 and SMA 2 because both of those will slip into this quarter, which is quarter 2.
Yeah. So then we will have piece of the
seeing SMA 0 starting to come down because that's where, when I said the first bucket resolutions have improved and the entry rates are lower. So the first bucket has started coming down, the second and third buckets are elevated, which will therefore slip in quarter 2 and then it will get washed off.
Sure. That's great. So secondly, about your tenor, we have seen one of the other bank, MD who has now got 3 years term. Basically had applied for a renewal of his term. Is there a probability that basically you can also, or the board can reapply for your term extension beyond 1 year?
No, yes, the answer is surely, why not? But at the same time, I think the only way we can answer this question is that there is a very strong management pipeline in the bank. We're all here to ensure leadership continuity. And the focus on our plans remains unhindered. And we are all working towards doing that in a very committed manner. We are all excited and enthusiastic about coming out of this and building a better future, which is something that I tried to outline in considerable detail today in my commentary. So I think more than that, one cannot say.
No, but so your continuity will be very much required to see through the strategy implementation that you talked about in the current call.
Well, I think that will continue unhindered. I think, like I said, there is a huge management pipeline, and this is very futuristic. This is the first, so we are just looking one further year into the future, and I think everybody wants banks to be secure, well led, and with competent, capable leadership, and I think RBL Bank is a fine example of collective leadership, deep management, and we've done a transformation one which ran extremely well for 10 years, and now there's a hiccup, this year, which is fine. In any bank's 10 to 11 year history, one hiccup which does happen. But the way we have strategic clarity and the way we have outlined the future, we are all set to build the bank of the future. And there is so much work that's gone into it in the last 2 years that I can only emphasize that there is a lot of enthusiasm and excitement towards that, which is exactly why we call it reset for Transformation 2.0, because we felt this is the time to, just clean the deck and, just focus forward with a mindset of growth and profitability and sort of bringing back the return expectations that stakeholders would have.
Sure, sir. That's helpful, sir. Thanks a lot.
Thank you. We'll take one last question, which is from the line of Ashwini Agarwal from Ashmore Investments. Please go ahead.
Hi, good evening, team. So, I'm going to circle back to the questions that have pretty much dominated the whole evening. And Mr. Ujay, you said that, you wanted to clear the deck and get expectations in line with what they would be as a going concern. So my question is, why not take the entire credit cost, the elevated credit cost that you expect in Q2 from SMA2 and SMA3 in this quarter itself and have the September quarter credit costs, come closer to normal? I mean, the banks moved into losses, very large credit costs that you've upfront paid. You've taken the provision coverage to 60%. Why not 65% straight up and be done with it? Why are you spreading it out over 2 or 3 quarters?
No. 65% clearly we don't have to do anything more. Our current conservative provision policies, are such where the policies itself provide for 100% or 75% in most cases. Therefore, without having to do, like this time, we had to take a conscious decision to take the additional provision. If I just went on forward based on the portfolio as we see it, 6%, 5% additional PCR would not naturally develop, based on the existing provisioning policies. So, and as it is, we are 61 and we have taken 4 additional from micro banking. We have taken, okay? And the policies will ensure that this progression on PCR is natural. It is not going to require another extraordinary, if I may say, action on our part. So it is exactly that we have said. We have said that 65% should be, so it is happening naturally. Now the way we have put out the business plan for ourselves, and the numbers are reflecting that. So we are saying that we will be able to absorb that, revive profitability in the second quarter, improve profitability in the third quarter, and hit a certain benchmark that we have targeted in the fourth quarter, which I have indicated. So it's a journey. Rest of it is a board and a management decision at some point,
Okay. The second question is again on
my micro banking book today is provided 83%, and I have another buffer. So, and for all the other businesses, I think we have elucidated our approach in a very elaborate manner today. So, it's a question of where you want to take it. 83 plus 4 is already a hell of a lot.
No, I agree with you. My whole point is that when you're taking 1,426 crores, why not take that number to 1,800 crores and be done with it, so that next quarter onward you revert back to the 700, 800 crore provision number and your ROA starts flowing through. What's the point of spreading it over to September, carrying it for another quarter?
it is not a spreading. It's also a question of I can't take more than 100% in certain cases. No? See, my point is that this is what we have declared today, at the end of the day. And we did believe that the feeling was a 65% PCR is well benchmarked to the better industry standards. We were short of that. We have brought it to that. Okay? And that is exactly what I wanted to say. We have done 61%. We've taken additional COVID buffer for 4%. And in the rest of the year, another 5% will happen on its own. So the PCR coverage could actually turn out by the end of the year close to 68-70% by itself. More than that, I cannot say. Yeah.
Okay. The second question is on operating costs. I mean, you spoke about hiring a consultant. You spoke about new branches.
Yeah.
Hello?
Yeah, sorry?
Yeah, we spoke about operating expenses. Rashi also asked this question. I mean, the delta in operating expenses, especially the other operating expenses, is about 107 crores between the March quarter and the June quarter. And if I compare it year on year, it's up by 150 crores. I mean, it's a very large number in the context of, asset book that's not growing. Even if I had, say, you added a number of branches, you kind of put out an effort to grow your credit card book. I mean, this number is very large. And it's a significant cost to income percentage point movement. I mean, if I just look at 100 crores delta between March quarter and June quarter and look at a total income of roughly about 1,600 crores, I mean, you're talking about a 5 percentage point movement in that single line item. Is there any one-off embedded there? I mean, I'm not able to understand. I mean, what kind of consultant costs 100 crores? How many branches can you put up in 100 crores? I didn't quite understand that.
No, so this is, it will have many elements, but I think the bigger challenge for us in terms of cost to income ratio that I mentioned is more to do the fact that with a similar cost base, we should be having a larger business, interest-bearing asset yields, etc. And I think that will take us some more time given the environment we are in, and which is why the cost to income will remain slightly elevated for this period. The other thing is that when we open branches, I think the full impact comes with a lag. So we will have a combination of that. We are also adding to technology costs. We will have certain assumptions that we revalidate at the beginning of the year in terms of actuarial costs, etc., which Q4 may not be the best benchmark for it. So there will be some nuances. I would expect, if I have to give some guidance, Q2 costs should be, give or take similar before it starts going up again with growing business. But as I said, cost to income, we will expect, a % or two higher before it starts reverting back to, a trajectory which is lower.
No, so that's my whole point, that, if you look at the full year number last year, your other operating expenses, this is slide 66, if I can read it. Yeah, was 1,500 crores, just short of 1,500 crores, right? You were saying that first, second quarter would be 1,000 crores and third, fourth quarter will be slightly more. So let's take 600 crores average for Q3 and Q4. So you're saying that the 1,500 crore line goes to 2,200 crores for fiscal 22. I mean, that's a very big jump. I mean, could you help us understand what's driving this delta of 600, 700 crores on an annualized basis?
So if you look at last year, honestly, the first 4 months or so, we really had no new business across all the retail businesses. So I think fiscal 21 is a very harsh comparison in that sense because we had the benefit of the past book in terms of income, but we did not have any new origination in retail. See, retail origination on asset side is largely upfronted in terms of cost. And we had almost 3 months of negligible or 2.5 months of negligible and very slow business in the next couple of months. So it is easier to therefore look at a run rate. At an overall level, we are at about 850 crores, give or take run rate, which will probably be there for 1 or 2 quarters before it inches up.
Yeah, I think this discussion, let me assure you there is no, I mean, if you are asking if there is anything mysterious or one-off? No. Answer is no. It's just the way Jaideep is explaining it. And, further detailing we can do offline. We'll also...
Sure.
Yeah.
Sure. Thanks. Wish all the best, sir. Thank you. Thank you, team.
Thank you. Ladies and gentlemen, we now conclude the Q&A session. If you have any further questions, please contact RBL Bank Limited via email at ir@rblbank.com. I repeat, the email ID is ir@rblbank.com. Thank you. On behalf of RBL Bank, that concludes this conference. Thank you for joining us, and you may now disconnect your line.